Audio test. Audio test. Been having issues. How am I coming through? Am I audible? Yeah. Okay. So I forgot to go live. So let me just. Let's go here. This is more clear to show. So we had the 200. We had a rise of the 200. So I went long here, then I pulled back. I started adding again here once I cleared this bar. I started getting out here right before the gap was filled. So as you can see, my last contract was right over here. Zoom. So then once it formed this bottoming tail, I started adding and started getting out. So that's pretty much it for my trading. So, but now we're kind of stuck in this roughly 50% range of this down move at the close of the day yesterday. So, gotta be careful here. Audio test. Audio test. Been having issues. How am I coming through? Am I audible? So as you can see here, now we're having, okay, so now I see we're gonna go down. Looks like we're gonna go down. See something here. I didn't mean to do that. I'm all done trading, but my hotkeys are, I think, uh, conflicting with some of the stuff. So, yeah, we got some news, 7 o'clock news. That's where we got this volatility. Let's see what the news is here. the doesn't show here. This is crazy. But we got the JOLTS jobs opening, consumer confidence. Yeah. Why doesn't this thing show? This is just useless. Anybody trading? Oh my god, allergies. Mm. 435.
behavior. Would be to slow down on durables rather than consumables. Again, we're in the small price point consumables area. So we think we have resilience as a category, we think we have resilience as a business model, and we have a growth strategy. So we think the Coca-Cola Company, its system, will do well, even if it gets a little choppier in the next couple of quarters.
And on the tariff front, are you seeing any sort of anti-American sentiment? There's nothing more American than Coca-Cola. But do you see a consumer response globally to anger, for instance, at America, boycotting America's products, whether it's on tariffs or there's reports a Latino group called for a boycott against popular brands because of the deportation and immigration policies? Is that happening?
Some anti-US sentiment does occur, actually sporadically, and that is true if you look backwards in history, and unfortunately I'm sure it'll be true in the future. Sometimes it's around false information, which some of those videos were around the Hispanics, that I think is abating. But there has been some negative sentiment in a number of countries and certain populations. What we do is to focus on our brands, and the crux of the matter for Coca-Cola is it is a global brand, but it has very universal values, and it has a very local business operation. And we find when we do face some of that negative sentiment, if we focus on the brand and the localness of its operation, made in country X by people from this country, and we reinforce affordability, that brings the business back. Obviously, it has a little dip, but it brings the business back. So it's a problem we've seen before. It's a problem we encountered in Q1. It'll happen sometime in the future, but we have a game plan to see us through it and bring the business back so we can stick to our overall strategy.
What about the MAHA movement, Make America Healthy Again? The HHS Secretary, RFK Jr., has called awareness to big food, big beverages. I don't think he's a fan of soft drinks. Is that having any impact in consumers' minds? I was talking to PepsiCo CEO, and he said sort of the demonization of big food in a way is having an impact.
We don't see new substantive trends in beverages. Can't speak so much to the food impact. We don't see so much the impact in beverages. Of course, we'll work with the administration on their plans, but over time we've been seeing that the portfolio has been changing its nature and its shape as we respond to consumer demands. We see the growth of Coke Zero. We see the growth of Fairlife protein. So we have seen consumers look for a broader portfolio of choice. We have full calorie options or low and no calorie options for almost all our brands. So we've seen that expanding for consumers, and we think that's a strategy that will work for the future to respond to consumer needs and make sure we're selling great products of high quality for the marketplace.
What about the rule changes, the artificial dyes? Is that something that, how much do you use that? And is that going to be a difficult transition that could lead to higher prices for consumers ultimately?
Yeah, we in a very small part of our portfolio, we do use some of the dyes that the Secretary has talked about, working with industry on a voluntary basis to try and get out. We look forward to hearing about their plans. Certainly, our number one interest is to use ingredients of very high quality with very robust science in the US and everywhere else in the world, and so we'll engage with the administration on that and see where that takes us. But our ultimate aim is to have a portfolio of loved brands with great tasting products that consumers want to drink, with all sorts of optionality on all sorts of dimensions. And if we focus on the innovation and marketing behind that, we can continue with our growth strategy.
What about the SNAP program? How important is it for you from a sales perspective if, for instance, soft drinks are banned from SNAP, from food stamps? That's been discussed. It's been floated. I think some states are trying to do it. Ultimately, I think the U.S. Department of Agriculture would have to be involved. But you must have modeled that out and are looking at that scenario. What would that mean?
Yeah, the SNAP program, our estimates of how much of our U.S. business is related to that is a sort of single-digit percentage of the business. It's clearly a way that the low-income consumers are able to buy beverages of their choice across a whole wide variety. I know that there's a lot of talk about and proposals to make some adjustments. We'll see where those will go. So it is a bit of the business. Ultimately, it will cost some money and it will be manageable. we'd like to continue to see consumers getting choice, but the administration and the states need to work through their programs on that.
Yeah, I mean, I think that's the pushback, right? Like the nanny state, even if they are trying to go for healthier beverages. James, we spoke earlier around earnings about China, and I noted that you grew in China this quarter. So I'm wondering what it looks like on the ground there, how the economy is holding up, especially with the big trade effective embargo with the United States at this point.
Yeah, we grew in the first quarter in China. I think that was a consequence of some refocusing of our strategy last year around our China business that has really allowed us to restart the engines on growth on brand Coke using the kind of Lunar New Year celebrations in the first quarter, making some progress on Sprite. The economy is in okay shape there. You're still seeing growth there. I think the trade relationship, the news is more in the second quarter and the third quarter as those restrictions and impacts start to come in. So I think the first quarter is not a leading indicator in that sense, but so far so good. And in the end, we're going to focus on what can we control and how can we continue to drive, which is what is ultimately a relatively local business from an operational point of view, and stay engaged with consumers.
And overall inflation, I mean, I did see there's price growth still, not like you had in previous years, but is it back to normal? Is it going higher? Is it going lower? What's happening with prices on your products overall?
Yeah, you've seen what we've been calling out for a while, which is the moderation of our pricing as inflation has been moderated. Price mix which was 5% in the quarter. There was 1% there from the very high inflation countries, so forth. So really coming in to the landing zone of a more normalized global level of inflation. Our long-term model probably looks for inflation in the 3% kind of range. So it's really coming into what we expect it to be, a kind of moderation and a normalization of global inflation. I think we're landing in that spot.
All right, good to hear. And finally, is it Fairlife? Is that still the hot one in the portfolio?
Fairlife in the first quarter of this year, on top of last year, was the #1 brand in terms of adding dollars to U.S. retail sales. So it's a great tasting product with fantastic intrinsics. Consumers are still loving it, and we're building a lot of capacity, huge investments in manufacturing in the U.S.
Who knew milk would be the hottest product in 2025? James, thank you very much. It's good to talk to you about all the big issues that you're seeing and thinking about. Thank you. It's James Quincy, CEO of Coca-Cola. As we head to break, here's our roadmap for the rest of the hour. Nike getting itself into another big new controversy. Talk about the fallout and what the company is telling us.
Plus, growing fears about the crucial home selling season. The CEO of Compass is going to join us. We'll get the pulse of the housing market.
Stocks trying for a sixth day of gains, 5 days in a row. Yesterday was the longest win streak since November. Now Nasdaq's higher for the month. We'll talk about if this rebound is real as Squawk on the Street continues.
AI meeting agent.
Despite all this continued tariff uncertainty, the S&P is coming off a 5-day win streak. That's the longest since last year. Here to help us break down some of the impact for global investors is Charles Dallara, former Institute of International Finance CEO and Partners Group USA chairman of the board, joins us now. Charles, great to have you back. Welcome.
Good to be back with you this morning, despite the continued market jitters.
Yes, we keep posing questions about those jitters to corporates on our air. It varies in their response. The airlines have been pretty downbeat, although the Coke CEO just a moment ago, not as much. What's your view on what the uncertainty is doing to recession risk?
Well, it's increasing it. There's no doubt about it. I think I admire Secretary Bessent's efforts this morning to tamp down the perception of uncertainty. But let's face it, it's still there. We do not know what will happen after the 90-day pause on the tariffs around the world. We continue to see the disorder that's created by this across-the-board 10% tariff implementation. But the big issue here really now is not just revolving around the negotiations with Japan and Korea, although it's welcome that those negotiations are proceeding. But the big issue is this two-way tsunami across the Pacific, which the U.S. and China have created, which are going to have a massive impact not only on the U.S. and Chinese economies, but also on the global economy. And it clearly will put additional round of pressure on prices. It clearly will create supply disruptions. And, you know, the dependency the U.S. has developed over the years to Chinese products is massive. 75% on consumer electronics, 75 to 80% on toys, 95% on some other basic products like metal office furniture. This is not going to be replaced quickly or easily. There will be a price effect and there's going to be a supply effect. So I'm afraid that the uncertainty will translate into some painful elements of certainty before too long if solutions aren't found and these massive tariffs are withdrawn.
Right. The clock is ticking, as J.P. Morgan wrote last night. Meantime, Charles, there are some stories on the wires today about Chinese diplomats fanning out around the world, trying to paint the U.S. as an unreliable partner. Mark Carney, in his victory statement last night, we are over the shock of the American betrayal, but we should never forget the lessons. How many doors are opening for other countries to assume some sort of global leadership role?
Well, we are opening doors. I think this is an unfortunate and largely unintended consequence of what's happening in our trade policy. Look, I think we have to roll back the clock a bit here to recognize that 5 different presidents over the last 25 years have tried to get a handle on these growing imbalances between the U.S. and China. And no one really has succeeded. So I appreciate the fact that President Trump is out of patience and wants things to change. But I'm not at all sure this is the productive way to do it. And we are creating a bit of a vacuum among our allies. And although I don't blame Mark Carney for saying what he's saying, I think it's really premature to jump to the conclusion that the world of open trade and the world of partnership with the U.S. is a bygone era. I think that despite the damage that has been done, the goals here are not unreasonable. It's just that I think they cannot not be pursued just through tariffs alone. There needs to be a broader macroeconomic set of negotiations between the key countries. We need a new G7. We need to create a new G8, which involves countries like the U.S., Europe, China, India, Japan, the UK, probably Korea, probably Canada. There needs to be a new framework for addressing these persistent imbalances, which are, after all, not just trade problems, but they have to do with surpluses and deficits on the services accounts, as well as the role of exchange rate. You know, there's been very little discussion in the last months about dealing with exchange rate issues here. But in 1985, when I was working for Secretary James Baker at the Treasury Department, we had to recognize that if you're going to tackle imbalances, you've got to tackle exchange rates as well.
Right. Charles, I wish we had a little more time, but it's got some breaking news today. It's good to see you again. Thanks for helping out.
Good to see
Charles
you as well.
Dallara.
Thanks for having me. Good to be with you.
Quick programming note, a whole lot more on the tariff front today when the Commerce Secretary joins Power Lunch. That's coming up at 2 p.m. Eastern Time.
We do have some breaking news. Speaking of tariffs, out of the White House on autos, Megan Casella has it for us. Megan.
Hey, Sarah, just a few minutes ago, we were saying we didn't yet have these details on the auto tariff relief front. Now I can confirm, according to a White House official, exactly what the president will be signing this afternoon. There are going to be two parts to this auto tariff relief. The first is a destacking, they're calling, of tariffs. This means that for auto companies that are already subject to the 25% tariff on all autos and auto parts, that remains in place, but they are no longer having to pay anything that might overlap with that. Mostly the steel and aluminum tariffs, as well as the Canada and Mexico tariffs. None of those will apply to the auto companies any longer. The other part of this is a rebate. This is going to be applied up front for the next 2 years to auto companies to sort of offset the impact of the tariffs. They'll get 3.75% back in the first year, 2.5% back in the second year, and that's going to be based on the retail value of the car and the percentage of it that's American made. So trying to offset, again, that tariff impact. And it's a way of sort of rewarding these companies. The Commerce Secretary, Howard Lutnick, is out with a statement saying that this is giving these companies some runway in exchange for cooperating so far with the administration and trying to move as much of their manufacturing back to the U.S. as possible. And again, guys, it is a busy day for news. So I also want to touch on one other thing, which is Amazon. We were speaking about this a few minutes ago as well, in the White House responding to a report about Amazon. The report initially said that Amazon was going to start adjusting its prices online to show the exact amount which was due to tariffs. An Amazon spokesperson now responding to CNBC saying, quote, "The team that runs our ultra low cost Amazon Haul store has considered listing import charges on certain products. This was never a consideration for the main Amazon site, and nothing has been implemented on any Amazon properties." So, guys, we had seen some impact in the markets on Amazon stock this morning after the White House called this a hostile and political act. Amazon now saying this is not under consideration for the main site. Guys.
Yeah, Megan, I'm happy for that follow-up as well, given we were focused on that at the top of the 9 o'clock hour when those comments were made by Colonel Levitt. Where's the money going to come from for this rebate for the automakers? Do we know?
We don't know yet. It could be that some of the tariff revenue that they've been talking about, how much that is some of what's going to be applied for the rebate. 3.75% doesn't sound like a huge amount, but it is substantial for these companies. It is only 2 years for this rebate, but the money has to come from somewhere. I will say we are expecting a lot more details on this from the White House in the next hour or two, as well as later today, once the president signs the executive order. So more to come, a worthwhile question in the meantime.
You're kind of a mixed reaction. I would think this would be market friendly, right, for the automakers, ultimately getting some relief there.
Yes.
But GM's still lower after results today. Thank you, Megan. Keep us posted. A lot of moving parts on the tariffs. One name gaining on results, Honeywell. After a beat on the top and bottom lines, organic sales there up 4%. The company tightening the range, but not cutting guidance, and it's being rewarded, up 5%. One of the top gainers on the S&P currently on the move. We're going to hit a bunch of earnings and what companies are saying about the impact of tariffs and what they're seeing as far as the impact of the consumer when we come right back on Squawk on the Street after a very short break.
Now.
Welcome back. I'm Pippa Stevens with your CNBC News Update. The Supreme Court will hear the case today of an Atlanta woman whose home was wrongly raided by the FBI. A team leader says his personal GPS led him to the wrong place. Trina Martin's lawyers are asking justices to revive her lawsuit, suing authorities to hold them accountable. The government argues it was an honest mistake. The House voted to send a bipartisan bill criminalizing the sharing of revenge pornography to President Trump's desk for his signature. The legislation, called the Take It Down Act, includes AI-generated images known as deepfakes, and it requires platforms to remove the content within 2 days of being notified. President Trump is expected to sign it into law. And power was almost entirely restored early today in Spain and Portugal after a massive outage hit tens of millions of people on Monday. The disruption grounded aircraft, halted trains, and shut down ATMs. The cause of the outage is still unknown, though Portugal's prime minister suggested it originated in Spain. Carl, back to you.
So a lot of thanks. As we go to break, check out some of the worst performers on the S&P this morning. A lot of earnings-related names. We'll talk about what CEOs are saying about the consumer in just a moment.
TURMOIL.com/30.
Welcome back to Squawk on the Street. Quick check on the best and worst performing sectors on the S&P today. Not a bad day for some of the big cyclicals. Infotech, consumer staples leading the charge. Energy and consumer discretionary lag. Energy actually, WTI flirting with a 5 handle today. Just 3 sectors holding on to gains for the month. Tech, communication services, and then within tech, some big names like Palantir, CrowdStrike, and ServiceNow.
You know, we didn't have a chance at the top of the hour because so many earnings and the interview with Coke to go through what companies are saying about how they're dealing with tariffs and what they're seeing in the economy, how they're dealing with costs. So just chose a few snapshots to give you a taste of what we're getting this earnings season. UPS, obviously it's a barometer of the global economy, of shipping, is impacted by tariffs. We know they announced that they're going to be cutting 20,000 jobs to save costs. And also they didn't update the guidance, got rid of guidance there because there's just too much uncertainty. Over 95% of the customers they said that they talked to, and they talked to thousands, have told us they expect to maintain their current business model, while the rest are considering several options, including trade shifts, transportation mode shifts, exiting the business. Most of these customers are also telling us they are letting inventory levels sell off, which will lead to lower shipping activity for now. And that's one of the takeaways on the UPS side. The stock is flat. Honeywell, we mentioned, actually, even though that's also seen as very cyclically sensitive, bucking the trend, it's one of the better performers today. They said their business has solid momentum heading into the second quarter, did warn that the economic climate has become increasingly uncertain in recent weeks, but they still raised their full year guidance for earnings per share, saying it will offset the $500 million in tariff exposure with price changes and other actions to protect the bottom line. So that one is being met well. Adidas, though, out this morning. Remember, German company, big market in the U.S. They have diverted a lot of the China manufactured products coming to the U.S., but they're still hit by the 10% tariffs everywhere else. And they're talking about price hikes in the U.S. for sneakers. First time we've really heard this more explicitly. They also said that they would have raised guidance, but because of tariffs, now they're not going to. In a normal world with a strong quarter, the strong order book, and in general, very positive attitude toward Adidas, we would have increased our outlook for the year for both revenues and operating profit. The uncertainty regarding the U.S. tariffs has currently put a stop to this. So, guys, it depends where you sit, right, in the supply chain. We know that sneakers are not manufactured in this country. Coca-Cola, James Quincy, it's all locally sourced and made. Yes, they get hit a little bit on aluminum, but not in any kind of material way. And so you just have to listen to these companies because they are having to lay out their exposure in ways that we haven't heard before.
Did you see Dana Telsey's note today?
On higher
where
prices.
She's tracking price increases of specific items, like jeans at Abercrombie week on week up 33%, or a Barbie doll at Target up 43% week on week. I think she's gonna keep doing this from here on out.
It's helpful to know. Look, the products are made in China. Toys. Yeah. Barbie, we mentioned toys. The Toy Association is worried about small and mid-sized businesses going out of business. Certain sectors are just more exposed than others. A lot has pivoted away from China after the last Trump administration to places like Vietnam, but there's still a lot of exposure there. I just wanted to mention also, just in terms of the macro, Hilton, because hotels have been very strong. Hilton and Royal Caribbean thought worth highlighting. Hilton said macro uncertainty intensified in March, which pressured demand, particularly across leisure, but not the case in the cruise business. Been very strong, and that's sort of a notable outperformer here. They said things were looking good.
One mover that's not earnings related is Hims & Hers, surging on news of this new partnership with Novo to sell the company's weight loss drug Wegovy. This is the 8th double-digit move for this name this year alone. Still to come, well, some growing fears around housing's crucial spring selling season. We'll get a fresh read from the ground with the CEO of Compass in a moment.
The Magnificent Seven continues to take center stage during this busiest week of earnings season. And of the four that are reporting this week, one trader thinks that social media giant Meta could be the ripest for trade opportunity. Tune into our Market Navigator segment later on today on Power Lunch for more on the potential profit possibilities, 2 p.m. Eastern Time.
Is everywhere.
Welcome back to Squawk on the Street. The rate on a 30-year mortgage rising, but it is hanging on at least below that key 7% level. Our next guest warning the housing industry hasn't felt the impact of President Trump's tariffs, at least not quite yet. Robert Refkin is Compass's co-founder and CEO, joins us, as he often does, at Post 9. Nice to have you here.
Glad to be here.
It hasn't been a great market for a long time, the world you live in. I want to actually start off with something that Diana Olick, our housing expert, has sort of passed along to me and get your reaction. Is it true that new construction homes right now are cheaper than comparable existing homes?
The new construction homes are getting cheaper than existing homes, and affordability is actually in a better place now than it was this time last year. This is the first time I've been here with you where I can say that. And that's because prices for homes overall are flat year over year, while the mortgage rates are 6.8% versus 7.4% this time last year. So it's actually cheaper to buy a home now than it was this time last year.
Why is new construction cheaper than existing?
Inventory. We now have 30% more inventory this time now than this time last year. And with more inventory, there's more options for buyers, but also less upward pressure on prices.
Remember all those times you'd come on and we'd be like, please, just a little inventory is all we ask. We finally got it.
Yep. Yeah, we finally got it. And by the end of this year, we should be in a place where we have as much inventory as in 2019, the pre-pandemic period. So yes, the era of there just not being enough inventory is over.
But the missing piece then is rates?
The missing piece to get back to the mid-cycle, which is 5.4 to 5.6 million homes sold a year versus the 4 million that we're at right now, which has been that way for over 2 years. I think you need mortgage rates below 6%, 5.99.
So a full point, essentially.
Yes,
yeah.
essentially.
And the likelihood of that, in your view?
I think that we will get there. It's just a matter of time, but I wouldn't bet that's happening this year.
What about prices overall?
So prices overall, they're defined by the actual price, which is flat overall, but the price drops right now. 36% of homes on the market have a price drop. That's more than any April in the last 12 years. And again, it reflects that when there's more inventory, that buyers have more negotiability relative to sellers.
And time spent on market also on the rise, I assume?
Time on market also on the rise. And that's why we at Compass, we launched the Compass Private Exclusives, Compass Coming Soon, where we can pre-market with no days on market, no price drop history. Almost half of our sellers, over 10,000 sellers this year, elected to start their home as a private exclusive coming soon, so they would be able to test price without the risk of a price drop.
That leads me to another question that Diana passed along as well. Zillow apparently announcing this month they're going to ban privately marketed homes from their site. So if it was first private, then goes public, it won't show up, they won't list it. Does that change the way you're thinking at all about these privately marketed
Zillow
homes?
is not banning private homes.
Okay.
Clear cooperation policy is not a rule against private listings. It's a rule around listings that are publicly marketed out of the MLS. So private listings which are not publicly marketed, NAR, the MLSs, Zillow, they're perfectly fine with it. But if you're marketing publicly outside of the MLS for more than one day, what organized real estate is saying is it must go through them. And so, look, we believe in choice, not control. And so we're just doing what homeowners clearly say that they want. which is choice as a private exclusive. Then do it for coming soon only one day before it goes to the MLS. But we always give the homeowner the choice on what they want to do.
Has this created tension, though, between your company and Zillow?
No, I have good conversations and dialogue.
Oh, yeah, it has then. If you give a laugh like that, of course it has.
No, I think it's actually, I think we're creating a new dialogue and good conversations with them. I think there are opportunities to work together. But regardless, I believe in homeowner choice, not control. And I don't know a single homeowner in the country that wants NAR, the MLS, or the portals to tell them how they must market their home.
Finally, do you think the SALT debate will be material going into the summer or then the fall, maybe?
Yeah, I think it will be, but I don't know what the results will be yet.
What about foreign buyers? They still coming?
We don't talk about foreign buyers as much as we used to. All right, I think they aren't feeling as comfortable as they have been in the past.
Chinese are not showing up anymore?
Not as much as a decade ago.
And how about cash deals?
Cash deals, we're still seeing a lot of cash deals because the mortgage rates are still higher than they were before, but also there's a lot of cash. Unemployment is still at a low. You have people with a lot of cash in their balance sheets, particularly in the high end.
We got through a lot of topics there. Thank you.
Absolutely.
Always appreciate it, Robert Refkin from Compass.
Coming up on Money Movers, the CEO of Novartis breaking down new numbers there and how he's navigating possible tariff impacts on the pharmaceutical space. That's at 11 a.m. And next, Nike in hot water over new advertising campaign that's caused a lot of controversy. Full story and the response in just 2 minutes.
Card for a free quote.
Welcome back to Squawk on the Street. Nike getting blowback for a billboard that it placed along the route of the Sunday London Marathon. In the billboard, it read, "Never again, period, until next year." Never again, of course, widely associated phrase with the Holocaust. Backlash quickly picked up on Twitter after the post shown here went viral. I talked to Nike about it. Here's what they're saying in a statement. Quote, "We did not mean any harm and apologize for any we caused. The London billboards were part of a broader campaign titled Winning Isn't Comfortable, built on runner insights and designed to motivate runners to push past what they think is possible." They say that there were a series of billboards with taglines such as, "Remember why you signed up for this. This is bloody tough." And then the final one was "Never again until next year." They were all placed along the route to inspire runners, and the copy, Nike says, was based on common phrases used by runners. Look, I think there are two things. One, in my reporting of all of this, it's clearly not intentional. It was not intentionally meant to cause harm. I think that's important to say because, the backlash on social media goes crazy up to the highest levels. However, I do think clearly it was wrong, and there's backlash not just about what they did, but about how they responded as well in the statement. There is a lack of ownership about why what they said was insensitive and why it was wrong, particularly because the issue here is around Holocaust remembrance. And Holocaust remembrance is all about awareness and making sure never again. And even if that, it's not something that you necessarily grew up with hearing or knowing about, it takes a quick Google or a Grok or a ChatGPT, which I put into all of them, and just Nike perhaps being more clear about the why this was wrong and struck a nerve, I think would have prevented maybe some of the backlash here, raising awareness that it was aware why this was a mistake.
It does seem a little strange that a marketing team as savvy as Nike's would be tone deaf on this one.
So many people yesterday texting and emailing me, how many layers did this go through? And nobody picked up on the fact that, especially coming on a week where it was Holocaust Remembrance Day, just obviously not a good look. It's not a huge issue for Nike, clearly. It's a marketing misstep. No. The bigger issues, tariffs, they're in the middle of a turnaround and they've got a new CEO, Elliot Hill, who's trying to convince people that they're changing the culture inside and outside of Nike. So this is not necessarily what they need at this time, self-imposed error.
All right. That does it for this hour of Squawk on the Street, at least. The S&P is up yet again, looking for what would be 6 straight days in a row if these gains were to hold. Live market coverage continues after this.
ABC.com. ABC.com.
You download Dave.
Now,